Hello. Today is September 7th, 2022. Let me start by saying that I am not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. So today we'll be talking about tax equivalent sell prices, and the reason I'm making this video is I recently made a video previously about MMTLP and next for hydrocarbons. The S1A has been filed. If you're not sure what that means, check out my last video. It talks about MMTLP, the S1A, what's going on, and it goes over it in detail. And also check out the earlier videos. In either case, so Nextbridge Hydrocarbons is about to spin out as a company, and we're almost at the S1 being approved, which means we'll be facing a choice soon, because there could be a short squeeze. You might want to sell, you might not want to sell, whatever. But if you're, it could be that you might fall between long-term and short-term capital gains, depending upon where you're, when you actually bought the shares. So anyway, big shout out to Greg Mathis, who let me know that I should make a video about this. I was not. At first I thought, oh, well, there's a video already, don't need to make one. But he pointed out that there needs to be an update, and it's timely and it's relevant. So thanks, Greg, for the update. So the thing is, if we look at MMTLP, it started trading on October 7th, 2021, and a lot of people bought at that point in time. I know I did. I'm not saying, at that time I thought it was a really good deal. I still think it's an amazing deal. And I bought without knowing what it was, but it's been almost a year now, right? I mean, we're at September, we're at September 6th, September 7th, and we're getting very close to time where, that initial buy could be going into long-term capital gains, which is a good thing for me, and a good thing for anyone who bought at that point in time. If you're not aware, the long-term capital gains rate is it's a special lower tax rate for those people who buy and hold a stock for greater than a year. Okay. The IRS likes to reward long-term investors. The U.S. government wants to reward long-term investors. They want to encourage that sort of thing. That's the reason why the rate is lower. And you can make a fair amount of money. If your stock appreciates over $459,750, you'll only wind up paying 20% at that rate, right? Because that's a 20% rate. If you're single, if you're married and filing jointly, you'll be paying 20% for anything over 500,000. So it's pretty good. It's a really good lower rate than you would normally pay in terms of regular income tax. Okay. Now, there's an additional tax that got put into place if you're going to make over a certain amount of money. I believe it's $250,000 or something like that now, and that's basically the net investment income tax, also known as the Obamacare tax or the additional Medicare tax, right? So you got to pay 3.8% for the net investment income tax, and an additional 0.9% if you make over $1 million. Now, you're probably not aware about that because you're probably, chances are my audience has not made over $1 million in stock. And it's something that you should be aware of because it's an additional tax. It's almost an additional 1%, okay? So the total Affordable Care Act taxes or the total Obamacare taxes will be somewhere in the range of 4.7% that you need to add on to the regular income taxes. In California, where I live, the top rate is 13.3%, so we get taxed quite a bit more, and there's an additional surcharge for mental health if you make over $1 million. So, yeah, that's quite nice. Anyway, so as far as California is concerned, in terms of total taxes for California, between federal and state and everything else, we wind up paying, if you're in the long-term camp, 38% total taxes, okay? Now, if you're in the short-term camp, well, if you're in the short-term camp, you're going to be paying a lot more. I'm in both, of course, right? We're all in both. But in either case, these are the tax brackets for 2022. And if we look at it, the top tax rate there, is, I guess I didn't have that. The top tax rate there is 37%. Okay, so if we look at that in terms of regular income in California, you could be paying something in the range of 55% total taxes. Chances are your state will pay less than California, but if you're in California, this is typically what you're looking at in terms of regular income taxes. You're paying more than half. Okay, yeah. So because of that, let me just do some quick tax algebra, and we'll figure out how this works out. Okay, because we want to know at what price would you have an equivalent net take home, right? So the way taxes work is you get your gross income tax and you multiply that by the tax rate, and that's the taxes that you pay, right? We can all agree on that. Now, when you take your gross income and you subtract the taxes paid, you get your net after taxes, right? That's what you wind up taking home. So let's take the top line, line 1, and put it into line 2 for taxes paid, right? That means your gross income minus your taxes paid, which is the gross income times the tax rate, equals your net after taxes, okay? That's just taking the top and then substituting that into, that's taking the taxes paid and substituting line 1 in, right? So we can do some quick algebra and factor out gross income. So gross income is times 1 minus tax rate will give you the net after taxes that you'll get, right? And we're just factoring out the gross income here, right? That's all. Very simple. So your net after taxes is equal to your gross income times 1 minus tax rate, right? That's just a given. So if you say that, we can do some other algebra, and we can say, well, if you take your net after taxes and you divide by 1 minus the tax rate, you'll get your gross income, okay? Why do we do that? We have these two equations at the end, right? And they're basically the same equation, just with some slight algebra after it. The top equation, though, tells you how much money you'll have after taxes, right? Your gross income times 1 minus tax rate is your net after taxes. The bottom equation tells you how much gross you need, right, if you want to get a certain net after taxes. So if you want a certain net amount after taxes, this bottom equation tells you how much gross income you will have to earn for that, right? So you take your net after taxes, divide by 1 minus the tax rate, and that tells you how much you will need so that you'll have that same amount of dollars after taxes. Okay, here are the equations. You can take a screenshot of this if you like, but basically it's raw algebra. Anyway, these are the two equations that matter the most, so we'll leave them up there. These are the only two equations that I'm going to be using now at this point. And the top equation, don't forget, is how much dollars you'll have after taxes. The bottom equation is how much gross you need to have that much dollars after taxes. Okay, so let's put in long-term capital gains in there, okay? So if we take the top equation, 1 minus tax rate, we substitute for the tax rate, we substitute total tax rate, long-term capital gains, right? So that means that the net after taxes for long-term capital gains, you can tell by just doing the estimated dividend price of MMTLP times 1 minus the total tax rate for long-term capital gains, right? Now, if we take that top equation and we put it into the bottom, okay? Don't forget the bottom is the net after taxes, because we're looking for an equivalent net after taxes to be the same, right? So if we want that same net after taxes for long term as we do for short term, we put in the net after taxes for long term. And then for the bottom total tax rate, we put in the regular income tax rate. That's a short term income tax. And that will tell you how much gross income you need for a particular amount, to equal the net after taxes of the long-term capital gains. Okay, so this is the short-term income that you need to get the same amount of money as you would for the long-term capital gains, right? So so we take those two equations. Now, if we look at this equation, we've got this estimated dividend price, and that means that your gross income is dependent upon the dividend price. So we don't really want to necessarily see that. We can just make this an overall generic equation. by dividing out the estimated dividend price, right? Now then we get the gross income divided by the estimated dividend price, right? To figure out how much money that you would need for that MMTLP price to get to, right, in terms of short-term capital gains. So the equation on the left, this is the premium that you expect the dividend price to be to obtain tax equivalents in terms of short-term and long-term capital gains, right? So this is a premium that you need for the short-term to equal the long-term capital gains. And if we do the math and we put that in there for California, we see that California, the total state taxes max is 12.3%, long-term capital gains is 20%, short-term is 37%. We put all those numbers in there. We come up with about 37% versus 54%, right? So we take that 37% and the 54%, we put that in there for the premium. We see what happens. That works out to 63% divided by 46%. And we get about 1.37. So for me in California, I would need a 37% premium in the short-term price over what I expect the dividend price to be in order to get equivalence, right? And that's the price I would be happy at. And that's at a minimum, right? So I would need about 37% more in terms of what I would be happy with as a sell price in terms of short-term capital gains. So if I would be happy with a particular sell price for long-term, I would need 37% more for short-term in order to have the same amount left over, right? Your state may and will vary, okay? Chances are you're not paying the high income taxes we are in California. So you can just, take the, you can just plug in the amounts for your state and then see what that is, right? You can put your state taxes in there, figure out what that addition is and all that. But instead of doing that, and then you'll wind up with the actual, you'll wind up with what your expected happiness premium should be, right? Let's just say. Okay. So in terms of California, if I expected to make $60 a share in MMTLP, an equivalent short-term price for that would be $82.20, right? If I expected to make $75 a share long-term, an equivalent medium price in terms of short-term for me to get the same take-home would be $102, right? Instead of having to go through all this math, if you don't live in California and all that, I made a spreadsheet up. And the spreadsheet is in GitHub. It's reg income versus long-term capital gains spreadsheet. You go to this website on GitHub, click the code button. You'll see this drop-down menu. Click download zip, and you'll get these two files, which are contained in the zip file. Okay, so you extract the zip file, of course, and then you'll get these two files, right? If you open up so the two files are the same files. One is in numbers format, and the other one is in Excel format. So if you open up the numbers format version, you'll see this. And the main thing is you enter in your state taxes where it's in red, and that will give you the multiplication factor on the bottom, right? The premium for the equivalent, for your equivalent. Let's say, so for California, it's 13.3%, right? For both long and short-term capital gains, they don't care. So if you pay zero income tax, suppose you're in Florida, right? How much premium would you need? Well, you'd still need a premium because there's a difference in federal, right? And that premium turns out to be 29.2%. So there you go. Now, this was the premium that I expect in California. So this is just what I think the equivalent prices should be as far as I'm concerned for my situation. I'm not a financial advisor. I'm just doing some math here. The math should make sense. And you're in charge of your own shares. So you do what's right for you. I'll do what's right for me. But, think about your taxes. Think about what, a good price point to sell at would be. This works for me because, I said this is okay as far as I'm concerned, right? And that's it. So I just wanted to say thank you for watching this video. And Let me end by saying that I am not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. Goodbye.